After a millennium of duds like tulips and collateralized debt obligations, it seems the finance industry has finally discovered a magic money tree. And its name is XIV. XIV is a so-called inverse VIX exchange traded note. And in practice, it bets on calm US stock markets through futures based on Wall Street's fear gauge. Now, this has recently been a staggeringly lucrative trade, given that US stock market volatility has only been lower 3% of the time since 1928. XIV has returned over 700% since launching at the end of 2010, and over 22% just since mid-April. The ETN makes money because the VIX futures market is almost always in contango. And that's jargon for when near-term contracts are cheaper than longer-term ones. XIV essentially just sells these longer-term VIX futures and watches them expire at a lower price and pockets the difference. In practice, this is like selling insurance against turbulence. The losses can be severe when turbulence erupts, such as after Brexit, when XIV lost almost a quarter of its value in just one day. But VIX futures have been in contango 70% of trading days since 2005, so the strategy does make money most of the time. Now, its sheer profitability raises a host of interesting questions. For example, many analysts are worried that there are too many people selling volatility insurance, concerned that these short vol bets could cause wider carnage if they unravel. But the lucrativeness of selling such insurance implies that there might actually be too few people doing so, at least relative to demand. Now, nonetheless, magic money trees do have a nasty way of proving to be mirages, or dying as too many greedy traders pluck their fruits. Over time, selling insurance is a good business, especially at a time of heightened fear. But if a hurricane strikes, the damage can be ferocious. XIV bulls should note that the ETN has a kill switch that can be triggered if losses exceed 80% in a day. Now, that may seem improbable, but given how low VIX is today, it is far from impossible.